Hey everyone, Jeff Dorman, Chief Investment Officer at ARCA, back again for another edition of That's Our Two Satoshis Live, where we go over all of the news and information driving digital asset prices for the week. For those who are new to this show, never seen this before, we also write a blog called That's Our Two Satoshis, available on our website at ar.ca, where you can read along and get all the full details and charts that come with it. Uh, for a reminder, this commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. All right, now back to what's going on in the market. So clearly, last week was a macro week. In fact, for those who do follow along what ARCA writes every week, it was only a few weeks ago where we said the digital assets have fully decoupled from macro. We didn't expect macro to be a story. So, of course, macro was the full story last week. Jackson Hole, meeting of economists, Fed Chairman Powell did not mince words at all, came out incredibly hawkish, putting the hammer down. Basically, for those who don't really understand macroeconomics or don't follow it on a day-to-day basis, essentially the Fed has been completely forthcoming and transparent with what they're going to do. But the market continues to interpret different words that they say in different ways. So a few months ago, the markets interpreted what Powell was saying as fairly dovish, meaning that they expected them to stop raising rates or at least potentially start lowering rates again soon. The markets obviously shot up. Digital assets up anywhere from 20 to 100% since the middle of July. Equities up 10 to 20%. The Fed didn't like that. They didn't want the markets to get ahead of themselves, given that there's more work to be done to get rid of inflation. So Powell came out with a hammer and said, "That's it. We're prepared to put some pain into the market. There's going to be higher unemployment. There's going to be some negative headwinds to housing and to the equity market, essentially saying this pivot is not going to happen." So that's great. We went back to all one trade. Digital assets much lower, equities much lower, the dollar higher, rates higher. We're back into another environment where if you're a short-term trader, you're hanging on the every word of the Fed. If you're a long-term investor, probably much ado about nothing, right? There's not a whole lot that happens on a month-to-month CPI report or really with these changes in rates that has a long-lasting effect on the market. So when I was writing last night, I was thinking about what actually happened last week? If it really was just the Fed, is there anything interesting that's going on in the market? Because, we're getting kind of tired of saying it's all one trade and it's just macro. But what I thought was interesting is if you actually peel back the onion a little bit and look at what's happening specifically to digital assets, you basically have two competing forces. On the negative side, you have probably the most important thing, which is that user growth, transaction growth, volume growth is all lower, right? It doesn't matter where you look. If you're looking at active addresses, if you're looking at fees paid, if you're looking at trading volumes, wherever you're looking across NFTs, across stablecoins, across Bitcoin, Ethereum, other parts of digital assets, it is painting a pretty bearish picture, right? Users are down, transactions are down, volumes are down, and any model that you run in terms of future use cases of these technologies and of the value accrual to tokens is very heavily levered to those three things. On the flip side, when you're in a bear market like we're clearly in, that's usually when you get the best investment opportunities, because you start to see instead of just poorly constructed tokens coming to market every 3 weeks that go up for 4 or 5 weeks and then all of a sudden crash down 90%, you're starting to see more creative financings, right? This is not specific to digital assets. You see this in the debt and equity world as well. When markets struggle, you get higher coupons, you get warrants attached, you get better covenants, you get all these investor protections when markets are not on stable footing. And the same thing is true in the digital asset world right now. In fact, there was 4 that caught my eye just in the last week alone that are completely agnostic to what's going on in the market, no beta, just pure alpha in terms of events that are happening in digital assets. So let's start with Uniswap. Right, Uniswap, one of the most profitable entities in the digital asset market. I think they have somewhere between 50 and 60% of total market share for all decentralized spot exchange volume. Clearly generate a lot of revenue, right? They charge a 30 basis point fee on all trades, but Uniswap is also famous for having a completely useless governance token, right? The token does nothing. It doesn't accrue any of that value. It's not used for anything. It was just airdropped and given away to users with no real plan. But, there's always been an expectation of what happens if some of those fees that Uniswap generates get switched on to the token, right? What if all of a sudden the Uniswap token goes from being useless to all of a sudden being cash flow generative? If that happens, now you've got a a massive yield on a $7 billion token with a company that's doing multiple billions of future and run rate revenue. That's something that should be trading probably in the 15 to $20 billion market range, just based on traditional price to earnings ratios of growth entities like this. So you can see why there's a lot of value tied up in whether or not this fee switch goes live. For the last 2 years since the Uniswap token was issued, it's kind of been swept under the rug, pushed aside. But now that Uniswap token is down 60 or 70% like everything else, and investors are hurting, these kind of conversations start to pop up again. So, we've been watching that very carefully. I think that it's inevitable that eventually you will see the Uniswap fee switch be turned on at some point. And that's the kind of event that, doesn't really get affected by whether or not we see Fed rate hikes or a slowdown in rate hikes. Similarly, Tribe, for those who followed Tribe DAO since its inception, one of the more interesting failed projects we've ever seen. They've been incredibly innovative. They're the first to kind of coin the term, I think, protocol controlled value. Basically, the idea of taking in the assets and being productive with them through DeFi applications. They also did the first, I believe, the first successful merger when the Tribe DAO merged with Fei and Rary. Rather, when Tribe DAO merged Fei with Rary. You've also seen a pretty large hack, a month ago, one of the larger hacks we've seen in the last few months. So a lot of interesting things have happened with Tribe DAO, but ultimately it was a failed project, and they've proposed to do a full dissolution of the Tribe DAO and basically give assets back. This is one where I'd absolutely recommend people go to the blog itself and actually look at the chart that we put in there. But this becomes a book value trade. This becomes how many assets are left in the DAO that are going to be fully liquidated and returned back to investors, and what's your recovery? And your recovery at this point, based on our back of the envelope math, looks like it's significantly higher than where the Tribe token is trading today. So again, that's the type of event trade, right? A book value trade or a liquidation trade, where it makes no difference what the price of Bitcoin is or what's happening with rates, that you ultimately will get your money back and then some if and when this proposal goes through. Third, we were looking at Luna, everyone's favorite failed project, the Terra Luna Foundation and the Terra Luna blockchain. Obviously, there was a fork. You have the new Luna chain as well as the old LUNC chain. UST trading for pennies on the dollar, clearly not a viable algorithmic stablecoin anymore. But, again, we wrote about this a few months ago as well, talking about the difference between a restructuring in blockchain versus a traditional bankruptcy that goes, through many years, right? You have Celsius and Voyager going through traditional bankruptcy processes, Three Arrows going through a traditional bankruptcy process, Mt. Gox now 8 or 9 years of this process in bankruptcy. These are not swift finishes when you go through the bankruptcy process. On the flip side, we saw Luna basically completely restructure in 2 weeks, launching a new chain, as well as keeping the old chain live. The old chain, however, was kind of on pause because you couldn't get enough validators because of the ownership of the old Luna token and how much hyperinflationary supply. Well, last week they finally got a group of calling themselves, I believe, the Terra Rebels, were finally able to relaunch and validate the blocks on the old Luna chain. And you saw a pretty big move in the LUNC token, rising about 40% last week. And I find this pretty interesting, right? You now have 260 billion or so Luna staked. It's sort of like a blank canvas. If you think about all blockchains as like a blank app store with nothing on it, you're betting on that eventually real applications are going to be built on there and real transactions are going to happen. Obviously, if you're Ethereum, you've already got a ton of transactions and applications being built on there and using every day, right? Ethereum looks a lot like the Apple App Store. If you're one of the newer chains, or one of the ghost chains that never really got going, you're basically trading like a call option, right? You're trading like this blank canvas that could one day be used for something, but right now isn't. And if you look at the market caps of all of the layer one protocols that don't have a lot of traction, your Cardanos, your Phantoms, your Avalanches, your EOSs, the floor on these tokens is about $1 billion market cap. And the old Luna token is trading significantly below that. So if you believe that, the old Luna blockchain, now that it's being resurrected again and has real blocks producing with real validators, there's an argument that the Luna blockchain, just purely on option value alone, should catch up to these other Ghost protocols that don't have any activity on them. Not to mention, unlike a startup layer one that has to fight for community, Terra Luna already has a large community. Certainly, a lot of people who got burned by the collapse of the Luna token, looking to make their money back. So again, whether this works or not, it's another event play that is happening independent of what's happening to broader Bitcoin prices or the broader macro economy. And finally, one of our favorites, we'll talk about DYDX, the leading decentralized derivatives exchange, has well over an 80% market share of all decentralized derivatives. I think it's a really interesting company or project in the sense that, if you look at Uniswap and Sushi and Binance Smart Chain's PancakeSwap and all the other decentralized spot exchanges, they trade about 15% of the total spot market. But if you look at decentralized derivatives, DYDX and the others, which DYDX making up over 80% of the market share, they only encapsulate about 1% of the total market share of all derivatives, right? The rest being FTX and Binance and the other centralized exchanges that trade all the futures products. So you're already in a potential growth industry if you believe that market share is going to increase, and you have DYDX, which does the lion's share of all of that trading. But this is an interesting one because, again, much like Uniswap, the DYDX token right now does nothing other than governance. This company has produced about $500 million of cash flow that has all gone to the company DYDX Trading, and none of it has gone to DYDX token holders. And that's why you look at the price of DYDX token and it's just straight down. You have an inflationary rewards-based token with no cash flows. Well, again, investors and token holders can only take so much. And you're starting to hear behind the scenes rumblings of, well, what happens? Can you divert those cash flows to the token holders? Or what happens when DYDX leaves the Ethereum chain and becomes its standalone blockchain on the Cosmos SDK? Well, when that happens, you're going to need a staking token. And when you have a staking token, you pay out distributions. And if you start to pay out some of these distributions, all of a sudden, something like DYDX, which only has a $200 million circulating market cap, but $500 million of cash flow, you can do the math of what something like this would trade like if you start to divert those or reroute those cash flows to the DYDX token. So we're starting to hear some grumblings about that. Again, that would be an event that is completely independent of the price of Bitcoin or macro. So the point being is, even though we're in a macro trade and we're certainly, in a macro trader's world on a day-to-day basis, when you look back 12 months, 18 months, 24 months, you're going to see real winners and losers. And a lot of those winners are going to be based on the things we just mentioned. So, we're watching the continuous Fed jawboning. We know that we're all getting whipsawed in terms of price action, but we think that there's plenty of opportunities in this market to look for other token value accrual mechanisms, token types that can be restructured in some way during a bear market to create some value. So that's it. We'll post some more on Twitter as we get other ideas, but that's where we're focused, and we think that's where the market's attention will be as well. So that's it for That's Our Two Satoshis Live this week. Again, you can check out our blog at ar.ca to read the actual article. And as always, give us comments and feedback on what you agree or disagree with. Thanks, everybody.